gives me pleasure to introduce this guy who's the director of the Division of Consumer Affairs at the Federal Reserve. But more importantly, this is somebody I've known for many years, particularly when he was the managing director at the Joint Center for Housing Studies at Harvard. So he, at least for me, my orientation with him is he was a real deep thinker, academic type, but also somebody who, when you sat with him and talked to him, you got a sense that he really genuinely cared about the issues we care about. And now he's in charge of the most important division in the Federal Reserve bank system as it relates to the work we do. And so I'm very pleased about some of the things that have been occurring since he's taken this position. So please give a warm welcome to Eric Belsky. Quick remarks.
Welcome. So first, I want to thank John, and I appreciate the invitation to be with you here today. As John said, I'm now the director of the Division of Consumer and Community Affairs, so I thought I'd say a little bit about what the division does and some of the issues that we're thinking about, we're focused on, given the interest that you have and the work that you do. And want to start by saying John has a better Boston accent than I do. Having been at Harvard for 18 years, I didn't pick up any of it, but he described it as Harvard, which is authentic. So, John, thanks for that reminder of my previous work and of being at Harvard. So, I first want to start by thanking everyone in the room for the work that you do on behalf of the communities that you serve. Obviously, every day you're out there trying to make difference in the lives of residents and communities that you serve. And we have found NCRC to be an incredibly helpful source of information on what the organizations that are part of the coalition are seeing in their communities, what they see as opportunities, what they see as challenges. Obviously, as you know, banks have an affirmative obligation to meet the credit needs of low and moderate income communities. And so we're always interested in ways that we can try to help support financial institutions do that kind of thing. And so as a result of that, we're often reading reports that NCRC has produced. We're in conversations with members of NCRC and members of the coalition on a wide range of subjects and topics. I know that NCRC also holds lots of events. We were recently involved with age-friendly banking events. The Philadelphia Federal Reserve Bank, as an example, did some work in that particular area with Bob Zdenek, and other reserve banks have as well. So we're involved and engaged in a variety of different ways. And when you hear sort of very briefly what it is that the division does, I think you'll understand why it's helpful to have as many eyes and ears on the ground that are represented in this room, helping us form a view of what's going on in those communities. So very briefly, DCCA is the part of the Fed that really makes an effort to make sure that consumer and community perspectives inform Fed policy research and action. And we do it through four things. One is we still write rules on an interagency basis, is the one I think closest to your heart, around CRA, but some other rules as well. We comment on all the rules that the CFPB produces and consult with them as they're developing proposed rules and finalizing rules. So there's a regulatory piece that we have. We supervise financial institutions for consumer compliance. That's compliance with consumer protection laws as well as fair lending laws. So there's some overlap there with some of the work that you do. And so supervision is a significant part of what we do. We're also the place where applications for mergers and acquisitions come, so we're involved in assessing the convenience and needs of the community. We look at it either through the lens of a primary regulator, if it's a bank that we specifically supervise, or through the lens of the holding company to the extent that there's a holding company involved. And we also look at managerial factors around how strong is the consumer compliance program in those communities. So that's a second broad area of responsibility is supervision. We make an effort, and this is one of those things we do to engage stakeholders to try to do a variety of things, one of which is to understand and hear what's going on out in communities, but also to help provide information about what we think are workable solutions to problems that we've seen. And that can be how to do consumer compliance well if you're a financial institution, or how to think about community development if you're a community development institution. So engaging stakeholders is important. And then we do a lot of research. And that research is really aimed at least 3 areas. One is around trying to understand what kinds of risks are consumer facing in financial services marketplaces, and are they changing? And that's part of our ability to understand how we might, as supervisors or regulators, respond. Another thing we try to do is understand conditions that low and moderate income households and communities are feeling. And then another, as I said, is understanding what works in the practice of community development, what works in consumer compliance, what works in financial inclusion, household financial stability, a variety of things along those lines. And we, as I said, do a great deal of research. Part of what we do is we oversee 12 Federal Reserve banks. And many of you may be in interaction with those reserve banks. I imagine that many of you are. And each of those 12 reserve banks has a community affairs officer. And that community affairs officer oversees a community development office. And we are very much involved with all of them as a group, trying to do exactly those kinds of things. Conduct research, engage stakeholders, do surveys of community groups, surveys of households. And those are kind of the 4 key activities that we focus on. I'll sit down after I just share a couple of quick thoughts again on what we're seeing. And the things I'm going to talk about are going to be no surprise to you because of the work you do. But I just want to give you a sense of how we're looking at the world and the landscape that we're seeing. And I'd say, first and foremost, it's informed by the fact that the financial services landscape has started to change, in part because of technology, in part because of changes in regulation. But fundamentally, many of you, if not most, are involved with trying to deal with the aftermath of a financial crisis that just had incredible impacts on low and moderate income communities. You know, we're 7+ years past the height of the financial crisis, and the impact of that crisis is profound, and I know you're all dealing with these kinds of issues. Home ownership rates were hammered, especially for minorities. There was a huge loss of homes and wealth to foreclosures. CoreLogic estimates that about 8 million homes were actually lost to foreclosure. Even more people faced that kind of loss of wealth through short sales. So 8 million homes plus short sales. Obviously, it was a tsunami and had very significant consequences. We at the Fed are obviously well aware that there's still elevated minority unemployment rates. And so while unemployment rates are kind of moving back to pre-crisis levels for most groups, for blacks it's still double that of whites, 8.8% versus 5.9% for Hispanics and 4.3% for whites. Incredibly still low volumes of lending, especially to minority borrowers, out of 3.26 million home purchase originations in 2014, which of course is still relatively low. A total of 157,517, if you count them up, went to African Americans, 263,000 to Hispanics, 883,000 to Asians. The other 2.5 million went to white borrowers. For Hispanics, it represented an increase off a floor in 2010 of about 8.6%, up about 10% for blacks, but up fully 28% for whites. So while the market hasn't come back overall, it's come back less for minorities than it has for non-Hispanic whites. Cash sales still account, as you know, for a substantial portion of the activity. Nationally, again, CoreLogic estimates it's a bit over a third, but I know that in many of your communities, it's an even larger share. And this poses a challenge in terms of people who may want to be purchasing those homes and would require a mortgage. because someone paying cash is able to secure the property much more quickly. And while the share of properties in distress has clearly gone down, it's still higher than pre-crisis levels, and many markets have a long way to go on those issues. According to CoreLogic, as an example, Miami and Las Vegas have negative equity rates of greater than 20% of the homes are still basically underwater. In Chicago, it's about 17%. And so I know that for many of you, you're in markets where if you're trying to do anything, or anyone in your community is trying to rehab a property that may have been deteriorated for any number of reasons, the appraisal won't cancel out. The value of the appraised property is going to be lower than the cost of acquiring it and trying to rehabilitate it. And there's obviously still very limited credit flowing to people with low credit scores. Average FICO scores are up dramatically. One number I look at is, what's the line at which 10% of loans and below are credit scores are. And so in 2001, 10% of them were below a 600 cutoff. In November of 2015, 10% were below a 668 credit score cutoff. So people with low credit scores are really struggling to be able to qualify for a mortgage. And then the average household is still struggling to accumulate savings and meet their credit needs. We do a survey called the Survey of Household Economics and Decision Making to look at the economic conditions of people in low and moderate income communities. And the number there is really quite staggering. 47% of all adults, this is regardless of income, report that they couldn't cover emergency expenses costing $400 without trying to cover it by selling something or borrowing money to deal with it. And when we asked people about whether they had been denied credit, offered less credit than requested, or put off applying for credit that they wanted to, we found that a substantial minority felt that way, and that the confidence in getting credit probably predictably was lower for Hispanics and for blacks than it was for others. We also find that people who lack bank accounts or who are looking to use alternative financial services outside the banking system are disproportionately low income, disproportionately located in areas of concentrated poverty. When you combine the fact that people have low incomes, they have a really hard time being able to save their income. And John and I were talking about this before I walked in, about the extreme extent of income volatility. We were basically talking about the whole situation with the metro. For us, it's an inconvenience. For many of the people you're working with and serving, it's a catastrophe. They're going to lose wages that day. They're not going to recover, and they have bills that they have to pay. And we're keenly aware of these issues, and we track them on behalf of the Federal Reserve. We communicate these kinds of things to the governors. The governors take this into their account and view when they work on the important work that they have to do on behalf of the economy. And with that kind of volatile income and lack of a cash cushion, Michael Barr called it, having no slack, that you end up with a lot of people taking out credit, short-term credit, and those are needs that they have, but they're typically costly to satisfy. And then you add on top of that the issues that around trying to develop human capital in the youth, and hoping that they'll be able to advance economically. And more of them, as you know, took on student debt. And it turns out, if you get a college degree, the return is likely to be quite high, because lifetime wages tend to be significantly higher and unemployment significantly lower among that group. But that depends on you actually completing the degree. And in many instances, people don't complete those degrees. So that's another challenge. When we asked in another survey, because we do a lot of these young workers, what we found is that if you ask people if they thought that they possess the education and training for the job they would like over the next 5 years, only 36% of people between the ages of 18 and 30 felt that they had that opportunity, that education. So the challenges are daunting, and then you add on top of that issues around small business credit. So we also do a Federal Reserve Small Business Credit Survey, and found about half of businesses seeking capital were funded, but it varies by size. So 3/4 of the largest firms were able to get funding, according to this survey, but barely 1/3 of small businesses that had revenues of $100,000 or less. So there's clearly challenges there. And the other thing shaping the environment, as I said, regulatory reforms. where we're still trying to understand how it's going to affect credit access and where things will really settle and fall out. So we're looking very carefully at those things because, of course, there was a lot of regulation in the mortgage lending space and the credit card space. CFPB is talking about or proposing rules around a whole series of things: overdraft, prepaid cards, unsecured, small dollar loans. So there's a lot that I think you all have to keep up with, and we're all trying to keep up with, and trying to understand what the implications are of those things. And then in terms of the evolving industrial sector, what's pretty clear, of course, is that consolidation continues. More and more decisions that you are trying to get made are not made necessarily close to your community. They're at greater physical distances, which I think is an obvious issue. But it also is that a handful of very, very large financial institutions and how they conduct their consumer lending programs and their Community Reinvestment Act responsibilities have an impact on a larger and larger number of people and places. And in this, community banks are struggling partly because they have a smaller base over which to spread a lot of fixed costs, including regulatory costs. So we're thinking and looking at those issues as well. We're noticing an increased reliance on third-party vendors by banks, and banks' responsibility to ensure that what they're doing complies with consumer protection and fair lending laws doesn't stop if they're working with a third-party vendor. And so we're very active in providing guidance and information about what expectations are about working with them. And then there's also expansion into new product areas that we're seeing as banks try to address what is a very small spread in net interest and look for new revenue sources. And for us, those are moments of heightened risk. They're moments where a financial institution's getting into something it hasn't before, has to make sure that it has the right systems in place. They're starting from scratch and they don't have a lot of experience. So we're looking at that as an important force. And then one I want to end on, which is the innovations in technology and data. And this, I think, comes back to some of the CRA related questions and issues as well. It's remarkable, I think, the extent of penetration of mobile phones and smartphones, not just across the population, but particularly among lower income Americans and people of color. And what we're seeing is high rates of adoption of both mobile phones and smartphones, and actually above average use if you have a smartphone for banking purposes among that population. Among the underbanked, 90% have a mobile phone, and 73% of those 90%, or about 2/3 of all those people, have smartphones, and half of the underbanked are using it to do some thing that looks like mobile banking. And we're finding is the main impediments to people doing more partly is preference. So some people want to go to a branch, or they want to go to a branch for certain things and not others. So we're seeing what has been, I don't know, it sounds very technical, but omni-channel uses of different kind of financial services. And technology, from our perspective, has both potential but also risks. And so we're very careful about trying to understand the potentials, some of which are very consumer-friendly, alerts to people before they buy something that may overdraw their account, automatic savings devices and tools. So you have alerts, they have ways to try to help people manage their investment decisions and their basic cash flows and financial lives, and giving them real-time information. These are all very positive developments. We're obviously also seeing a series of players come into the consumer lending, largely around debt consolidation space, but also in the area of small business lending. And what we're seeing there and trying to understand is what's going on. So we've heard from many community groups and have done some focus groups, and actually this Federal Reserve Small Business Survey asked some questions about online, the presence of online small business lenders. And 1 in 5 firms said that they had applied for a loan online. And of that 1 in 5, a fairly high proportion are approved. The approval rating is about as high as it is for smaller banks. But the level of satisfaction is lower than it is with smaller banks, with the main complaint being high interest rates. And there's been a lot of reports and discussion about confusion they feel around disclosures around fees and other things and how the loan's actually going to work. And again, this is something that we've picked up in through focus groups that we've had, as well as through some of the survey work that we've been doing. So we're still forming a view, but I think this is important for you to understand, because obviously some of those small businesses I'm talking about are in your communities, and we're all trying to understand where this may land. And some large banks are engaging in partnerships, some are building their own platforms to be able to accept things in an online way, if for no other reason that the online origination is much faster, and many small businesses are, trying to meet their cash flow needs on an immediate basis, and the speed with which they get the funds matters significantly to them. So in terms of the things that we're looking out for in where we're moving now is a lot more research on a lot of the topics we've talked about. One of the things that we are good at the Federal Reserve at some level, a large part of what happens at the central bank looks like a research institution. So we're continuing to do, and will continue to do, this survey of household economic decision making that gives us insights into condition and how people are making decisions. We're going to extend work that we did in 2015 that I don't know how many of you were able to make it, but we did a conference on economic mobility and research around economic mobility. We continue to do that. And recently, we have been trying to understand whether impact investing represents a new potential source of capital for low and moderate income communities, because as I said again, one of the things we're trying to do through this whole function is to try to help banks meet their affirmative obligations to lend in low and moderate income communities, and we're trying at the Reserve Bank levels to help stakeholders, industry, financial institutions, businesses, government, community groups get together and talk about local challenges and issues and provide them with information that's helpful for them to kind of dimension those issues, size those issues, and maybe get some thoughts as to what they might do about them, and hope that they are able to together move forward to address those issues. So potential sources of capital to low and moderate income communities are important to us. We're going to repeat the Young Workers Survey to understand where they're headed and where things are going. On the financial technology side, we're studying these different business models, as I said, the firms in the space. We're considering positive benefits of the technology can bring, while also being sensitive to the consumer risks they pose and ensuring that they're being well managed by the institutions that are providing these services. And we're obviously having to think about the implications of what I call omni-channels, or multiple channels, mobile, online, branches, and the implications of all of this for how we think about and we assess CRA performance. So, I want to thank NCRC for its leadership around CRA. As you know, we hope to very shortly publish a final set of CRA Q&As. It takes some time because we do try to weigh all the comments that we get, which are considerable, and land in the right place on those things. Beyond the Q&As, we are doing a number of other things as well to try to improve consistency across agencies and within agencies. We're looking at our examination procedures and sharpening our pencil on that. We're looking at how we write public evaluations and looking at the ways that we can make examinations, as I said, consistent. We're looking at the opportunities that the proliferation of new data may create for strengthening our ability of examiners to look at performance context and think more and say more about that in the evaluations. And to inform that process, we're also looking at the current state of how our exams are being applied in the field, and the regulations and the questions and answers and guidance are being applied in the field. And we appreciate suggestions that we receive, both about the mechanics of CRA, but also broader issues about regulatory options that people feel we should be considering should we reach a point where we're looking and working more actively on rules and regulations. It's also worth noting that we constituted a community advisory council, and it just got stood up this year. I want to give a call out. I said I would to Arden Shank, who's on your board, who's one of the members of the Community Advisory Council. But this is a very important body. It's made up of leaders of community-based organizations like your own, so that governors hear directly from people who are doing this work about what they're seeing, the challenges they're facing, the concerns they have, the opportunities that they see, and that, as you can imagine, one-on-one interaction, especially that will be sustained over time with people serving 3-year terms and really developing relationships with some of these governors, is very important to them really getting the message. And the board of NCRC, since I've been here, met last year with the chair after or towards the end of your meeting. I don't know if it was after, towards the end, John. But then again, met with the group we'll be meeting with the group at the end of this week. And those meetings have been very effective. The people you have on your board come to those meetings well prepared to really try to have a substantive conversation with thoughts about what they feel the regulators should be doing. And again, having that ability to sit down and have that conversation, which they do with a variety of community groups over the year, is really important. But as I said, the level of preparation, the thought, the resources, all the information they pull from you, not only do they do an effective job, but they have the credibility of knowing that they're gathering the views and information of a lot of people very committed to trying to make their communities great places for the people who live there, and from the perspective of CRA, for community investment. And so with that, I'll, I guess, sit down and John will ask me some questions. Thanks.
Thanks, Eric. You can take the academic out of academia, but you can't take the data out of the academician. There's a lot of good meat in what he was talking about. Maybe we can make sure we get that data
Happy
to everybody.
do it. Yep.
Yeah. So for our members here, these are the folks who are on the front lines of having conversations in their communities with financial institutions. And we look at financial institutions as, we look at them a lot of ways, but one of the ways we look at them is they're our neighborhood's best hope. Yeah. If banks do not have a focus on our neighborhoods to do investment, to do lending, to do services, to put money into those neighborhoods, the likelihood of any type of economic prosperity is slim to none. So it's important to us to find ways to build relationships. And key to that is the work you do and the work the other agencies do to enforce CRA and the fair lending laws. For the longest time, I think if you were to poll our members, you'd have the impression, most people would give you the impression anyway, that there's been, well, since the recession, a kind of a stepping back away from the enforcement of the CRA and the fair lending laws in particular. And the result has been, if you look at the latest HMDA data, when it comes to low income and minority lending, it's really awful in the last 6-7 years. I mean, it's remarkably different than what it was. So CRA exams, performance evaluations, what the examiners say in those exams, whether a bank is rated as outstanding or whether it's rated satisfactory. I mean, all that really has an impact. And lately, we've noticed you actually gave failing grades to 2 significantly sized banks. Perhaps the 2 largest banks that I can remember have ever gotten a failing grade. And then you have a number of, I think particularly with the OCC, you have a number of the regulators now asking that there be forward commitments, plans, that if you're going to require somebody, tell us what your plans are. And not like there'll be a product here and there, but a real detailed plan about how this is going to really benefit communities. Long-winded question, obviously, but setting up this question. Is there a new renewed commitment? Is there a new era, a new day of CRA and fair lending enforcement that we community groups can look to as a support for the work we're doing? Is there something new happening in the agencies? Or?
So, I'd say a couple of things on this. First, it's disappointing in the sense that you feel that there's been, less enforcement of fair lending. I view it, I think, differently. I think there's been vigorous enforcement. Clearly a lot of issues were revealed by the financial crisis. The attention to fair lending was always significant, but there were more issues discovered, and so there's a lot of energy and effort into fair lending. And I know, because this is one of the areas that I oversee at the Federal Reserve, as you'd imagine, and all the other regulators the same, they take our obligations to make sure that banks are complying with fair lending laws very seriously. We spend a lot of time looking at things that might be a signal that there's a potential concern, trying to understand whether that initial signal really constitutes something that was a violation of law. So we're very focused on that. In terms of CRA and the downgrades that you've seen, every bank is a specific case, and every examiner is charged with doing a thorough, as you know, evaluation of the financial institutions, and I think the reasons for those downgrades in those cases were very particular to those specific institutions, which is, I think, exactly the way it should be. So I think, again, that what you see is a reflection of what we're seeing and what we're picking up. And we're always, very focused on the quality of our CRA examinations. As I said, looking for opportunities to ensure that we're consistent in the way that, as a pile this high of Q&As and guidance work. And so I guess what I'd say on the flip side from your perspective is we call them as we see them, and if we see a problem like that, it doesn't matter the size of the financial institution, we're going to call them.
So let me push back just a little
Sure.
on that. So you've got branches closing all over the place.
Mm-hmm.
Under the argument that, it's the new technology, when a lot of it's really just a way of maximizing profits. It's not like a lot of these branches, or even the majority of them, are necessarily losing propositions for institutions. They're just closing them because they create greater profitability. They return more to shareholders. Not a bad goal, but not exactly in compliance with meeting the credit needs of the communities they're chartered to serve. And so you have, and in particular when it comes to branch closings, often you'll have institutions that might be closing 30, 40 branches, and they'll say, we're only closing 10% in LMI areas or communities of color, but that 10% may be the last branch standing.
Right.
And then you put that together with the HMDA data, and you see small business loans are as rare as the dodo bird, I think, in communities of color at this point. And then even home mortgage loans have there's been a retrenchment away from people who do not have almost a 20% down payment and pretty strong credit scores. The kind of things that Fannie and Freddie securitized, that the market was willing to do, not obviously the predatory subprime stuff, but
Right.
the sustainable loans, that's almost gone in a lot. And that's the number one way that low-income people and people of color who are working their way out of poverty build wealth. So how does that gel with 98% of all the banks getting satisfactory or outstanding CRA grades?
So, I think you've kind of asked a couple of things in there. I mean, one is around branches. So if I forget the other ones you said, you remind me where you were headed. But I'll start with the branches. On the branches, yes, we're seeing increasing branch closures, and we look at that from two perspectives. One is redlining, which is a fair lending issue, which again falls within the orbit of the things we look at, and we have a whole series of established measures to determine whether we think this would be on the race side. It's a fair lending issue. Those closures constitute something that is a fair lending violation. And so we, in all our supervised financial institutions, which are the ones we have responsibility for, is about 840 or 50 state member banks, fluctuates. We look at all those issues. Then on the CRA side, of course, it's part of the service test. And to the extent that a change in the branch footprint of that financial institution has resulted in a view of a diminishment of the ability to service low and moderate income areas. Examiners, have the ability to, on that factor, rate that financial institution as it needs to improve or substantial noncompliance. And the way that they're looking at how those closures have affected those communities, in some cases, you get low ratings on the service test. So again, it's a case-by-case specific thing. The broader question about, which I think is the second part of your question, so I may miss the third part, John, so forgive me if I did, you could remind me, is the downdraft in credit, which I think clearly is a significant downdraft. It's the market basically responding to a whole series of things, some potentially regulatory, although some work that was done by some economists at the Federal Reserve Board on the effect of the ability to repay rule, at least so far, didn't feel it had a dramatic impact. It may have had some. They have very complicated ways of divining these things. But certainly you hear a lot about, as you know, concerns around put-back risks to Fannie or Freddie, and whether that larger part of the market, and now the asset-backed securities market, where some of the most troubling kinds of loans had been originated, hasn't come back. And you have these large financial institutions worried about delinquencies that may occur and how that may affect their having to repurchase loans, and Fannie and Freddie being big suppliers. If those guys don't reach a different conclusion about what's the right credit score barrier, and I'd say the same with FHA, as you know, because FHA, even though it's the one really low down payment game in town with a few kind of inching back into the space, but FHA being very important, their credit scores have also gravitated much, much higher. So that's why I say there's no question people are having difficulty, and to the degree that there's any correlation with those things between race and income,
Let me ask you,
get a
just
bigger
because you brought up
bigger effect.
FHA.
Right.
So how do you feel from a fair lending perspective? If a bank announces, I'm not going to do FHA lending, and when you consider that for FHA lending, about 75% of all African Americans and about 80% of all Hispanics in getting an origination get it through FHA because of the low down payment and the other terms and conditions. So when we talk about meeting the credit needs, and an institution says, I'm not going to deal with FHA, and they have these reasons, and it has to do with putbacks and so on. But from a fair lending perspective, how does that sort of resonate within the Federal Reserve on, well, gee, how are you going to meet these credit needs? Of all of a sudden, African Americans and Hispanics no longer need mortgage loans? So,
Right.
yeah.
Yeah, so I think, again, the fair lending laws are, as you know, very well established, very specific, and they're very important because, there are a whole series of laws that were put into place to protect people's civil rights and their fair lending, and make sure that their lending is fair. It's fair within the context of the lending that they're doing. So you would have to look at what does the subtraction actually involve, and as you said, to the extent that businesses are making business decisions based on a whole range of factors that they need to weigh, your question is exactly right, is does that trigger something when you look at the financial institution? But typically, if they were having a problem in one area of their lending that looked like a fair lending violation, we'll have picked that up already. The fact that FHA gets pulled out of it, it would be a case-specific thing, but I'm thinking, more out loud about this. But it's an interesting question.
Yeah. I mean, there was 1 week last year when the Supreme Court had something was in the Kool-Aid. They had a week where they were making liberal decisions, and one of them was that the doctrine of disparate impact applies to housing, and I would suggest that with that finding, there's also this causal connection between when you make a decision that has a disparate impact on a protected class of people, there may be a fair lending there. But I think there's also a CRA
and there are CRA
so.
considerations as well. I would say, of course, the disparate impact doctrine, was upheld. Some things were clarified and more specific suggestions around tests for it. So we're obviously very focused on those issues, and we've as have all the regulators, followed that doctrine in the Supreme Court decision, as I said, with, whatever footnotes it provided to that, sustains that.
Right. So I know that we don't have a lot of time, so I've got to try to rapidly go through a couple of things here.
Sure.
One is, we're now seeing more and more, and I mentioned that Tom Curry, who's going to be speaking here Friday morning, the head of the national banking system, they've been talking more and more about requiring forward plans from financial institutions that are merging. And we have found in a number of instances, one bank, which I don't know if I can mention it by name because they have an open application with you. Should I not mention them?
Yeah, I wouldn't mention it.
I had this bank in Ohio.
I'd
All right.
avoid saying too much about
No more. I
specific
won't say
financial
anymore.
institutions, yeah.
Except to say, I think, I think there's nothing here because we're going to actually do a press conference on Friday about this, but it was the right way for it to happen. There was encouragement from the regulators and really a willing bank willing to sit down and listen to a lot of community people, an organized series of meetings with the CEO of the bank, who I'm sure is busier than you or I, But she managed to find the time to sit down and talk about what the needs were, come up with a plan, allow the groups to respond to that, and then go back to the drawing board, come back with a better plan. Am I violating anything?
So, John, you're not going to like my answer, but I
Okay.
can't comment on this whole question because of the nature of the
That's
question.
all right. I wasn't expecting to comment on that, but what I do want to comment on is this is actually a wonderful tool that really gets at the notion of recommending that banks create forward plans that are public, not something that sort of gets negotiated at the early stages of when they put in an application just with the regulators, because that's kind of undermining the public process, right? Because if you've already done it with the bank, I'm not talking about any bank, I'm now being generic. You can actually join this conversation. But what it does for us is it really allows us to give very specific feedback on what those community credit needs are, and then respond to what the bank thinks its resolution or its commitment is going forward. That's of tremendous value to our neighborhoods.
So I would say obviously, one of the expectations we have of financial institutions with respect to CRA is that they be in communication with community groups and banks, because the regulations around CRA have been established, and haven't changed since 1995. Really understand, the expectations on them. And so banks should be in constant communication with community groups like the ones here, as well as other community groups, around how those community groups are seeing those needs and how they're going to work on making sure they're meeting the needs of their communities. In the applications context, it becomes more of a conversation around, convenience and needs. And certainly the laws governing reviews of applications talk about assessing a whole variety of things in the context of reviewing applications, including convenience and needs, including managerial factors, including competitive issues, and a whole range of them. So they're always taken into account.
So you mentioned the regulations from '95. They haven't changed since then. They change a little with the Q&A. When
Right.
you issue Q&A, it gives more guidance.
Guidance, but not the
So we've
same as reg.
been very patiently awaiting the latest Q&A, and I heard I've heard the word soon, and I think I heard that 2 years ago. I'm pretty sure I heard soon.
So
But,
it's sooner than it was 2 years ago, John.
But
That I can tell you with some
I know you can't give
certainty.
specifics.
Right.
Was there anything in there that addresses assessment area issues?
Well, the broad things that were being covered in there, and the proposed Q&A went out there. We're staying within that space. We're responding to comments based on those things. We are close, and I would say close. And so, you'll see soon what the specific decisions were made, as I said, based on sifting through a lot of evidence.
I'm getting the high sign that we're out of time, but one thing, and this is going to be very odd, I don't even know if you can address it, but one of the concerns that a lot of our members have is there's this impression that the foreclosure crisis is over. And what's going to sort of, in some people's minds, perhaps in reporters' minds, maybe in regulatory and legislative minds, what's going to confirm that is when HAMP and HOP disappear in November. Right. And what disappears with them is this bright line standard on what a modification ought to be, the sort of minimum standard that the industry uses. And so because that's about to occur, what's happening now is the industry is beginning to define what a modification is, which has more to do with streamlining modifications than necessarily be a foreclosure or a modification being connected to the income of the borrower. And so there's this debate going on. And there's going to be this dire need for the regulatory agencies to come together with Treasury, with FHFA, with HUD, with everybody involved to create a standard that the industry can look to and say, okay, this is what at least the prudential regulators and Treasury and FHFA and HUD and others think ought to be the standard going forward, with or without HOP. Can you be extremely explicit about your commitment to that?
The CFPB writes rules now, as you know, under a whole series of rules, but they've been active in writing rules and have already promulgated quite a few around servicing, and they're paying close attention to all the kinds of discussions and conversations. They're also, partly because they're obligated every 5 years to review their rules, they're looking very closely at what's going on in servicing. I think where you started is right, that there's significant numbers of foreclosures. They're down dramatically, but to the individual who's been foreclosed upon, it's it's as consequential. And in many of the communities that some of the organizations here serve, they've had a chronic problem with foreclosures. There were studies I remember being done in Chicago that showed it was not uncommon for the same property to have been in a foreclosure several times over a 15-year period. And this is before the financial crisis. So the issues of how you deal with distressed properties, foreclosed properties in communities, especially if there's a concentration of them, are very significant. And as you said, one of the ways that those things can be addressed is through how a troubled loan is handled and whether a foreclosure is ultimately averted and avoided. I think the industry learned a lot of lessons from it. Investors learned lessons from it, and so we'll see, where that leads.
Well, hopefully that will also be a conversation within the regulatory agencies where they see a role that.
Well, as I said, we consult on every rule that the CFPB does, so we're certainly, we pay attention to all the topics and issues that I think you would imagine that we would.
Well, I'm going to make us start running late in the workshops, but I'd be remiss if I just didn't ask you to give me sort of the elevator response on public benefit and its role now as you consider applications from banks, defining what the public benefit is in applications.
So again, on this one, we do it in two ways. One is or three really. There's some specific guidance. There's Regulation Y, which lays out the specific factors that we consider in reviewing applications, and we expect financial institutions, therefore, to be able and prepared to speak to. We often end up in information requests from financial institutions if we feel that the extent to which they talk about public benefit with respect to the things that I'm focused on, convenience and needs, and the effectiveness of their consumer compliance programs, we seek to get that information, and we'll continue to do that. But also, I think you know this, but worth noting is every public order, there's a lot of ink in those public orders, and some of the things that we expect of financial institutions as they occur to us in individual applications will, in the public order, say something that signals that. And so the combination of those gives a pretty clear view of the things that we look at. But absolutely, that is our statutory responsibility, to consider public benefits and to get sufficient information to be able to do our jobs.
Well, Eric, I appreciate your coming here, and I'm sure the audience appreciates it as well. Let's give him a big hand. Thank
Good
you.
to see you, Joe.
Nice to
Thank
see
you.
you.
Okay,
All right.
okay.